period, we have added a few new holdings to the trust, but as always, we remain very consistent with our quality growth momentum process. I think what I find quite interesting about periods like this is that actually the process and the use of the matrix, our stock screening tool, really helps to highlight and tilt us towards stocks which, through different environments, might be becoming quality growth momentum. And I think that really helps to flag up those new ideas which we either research and which a handful of we take forward into buying into the portfolio. I think this period has been a time of quite a lot of macro uncertainty once again, and we've actually seen quite a different environment in January, February compared to in March. But overall, our process remains very consistent, as do the holdings in the portfolio. Through the first 3 months of the year, Q1, I would say we've seen two different environments for performance. We've seen January and February remain strong for markets, but tougher for us on a relative basis. And I think that was really characterised by the recession environment. So looking back to November, the Bank of England was talking about a tough 2-year recession ahead. And really a lot of that view changed early in the year. And we saw much more of an environment where value stocks were leading the way. And I think that was characterised by the strength of a lot of consumer data that we saw out of, for instance, retailers, travel businesses early in the year. We saw that despite the cost of living crisis, the economy was actually remaining strong and we were at full employment. And actually that positive sentiment led the market more in favour of value stocks. And that typically is a tougher environment for us to perform relative to the benchmark. A more favourable environment for us on a relative basis was actually when the market got tougher in March. And that was really driven by the SVB Credit Suisse banking financial crisis, which appears so far to have been quite short-lived. And what we saw from that was a reminder that actually everything is not on a straight line pathway to recovery. There are still macroeconomic challenges ahead, and we saw the market sell off and we saw more of a focus back onto the resilience of quality businesses with good balance sheets and strong cash generation, as well as growth businesses who have more levers for growth, whereby even despite what might be happening externally, they continue to execute strongly on their growth strategies. So we saw our quality growth process more in focus of the market through March. Through the period, we did add a few new holdings in the trust, and those include Ricardo, FDM and Spirent. Ricardo, for example, is a stock that we have owned historically as a team, and really their transformation strategy into being an environmental engineering consultant is now in full flow. We're seeing really good earnings growth from them, meeting and beating expectations, and we think their strategy is well placed to benefit from a lot of the structural regulation trends of ESG across corporates and governments. We also saw that we were still building up some positions in newer holdings that we bought in previous periods. So we continued to add to the likes of Coates Group, Paragon Banking, and Smart Metering Systems. Where we were taking profit in the period was often from some of our bigger holdings where we were looking to control position sizes. These would include things like Kainos and 4imprint. We'd completely still believe in these positions, but we wanted to control our position size as they had done well recently. Two of the positions I mentioned in terms of trading, I think, are interesting ones to bring to life. 4imprint is a business that we believe is on a really great growth strategy. They had a tougher period during COVID, as this is a US-focused promotional products business, and a lot of that needs face-to-face interaction and events. But really, they've come out of that period thriving. And a lot of this has been driven by something that they tested before COVID, which was doing very well, which was marketing. And they've really seen a very strong return on investment from marketing spend in what is a very, very fragmented market. And we've seen them continue to invest in that last year and take market share with quality new customers who are delivering repeat orders. We also believe that they held back a bit of that marketing investment last year. So they really wanted to ensure that they had the strong customer service quality to execute. And now that they've hired and trained more individuals, we think they can push the button again this year on strong marketing investment. Coates Group is another business that we think has a very strong strategic profile. This is a global business who are focused on thread manufacturing that goes into apparel and footwear. What we see about them is really something quite unique, which is the focus on sustainable thread as part of their business. And we've really seen them invest in that strongly. Many of the retailers that you will hear of and purchase products from, I'm sure you've noticed, have talked more about sustainable products or conscious. And this is really only possible because of the likes of Coates, who are investing in that sustainable thread input. We think that continues to differentiate them and provide some really attractive, high-profile growth opportunities at attractive margins. Another thing we like about Coates as a business is their strategic projects. And that means that they've got a lot of projects ongoing in the departments, which we think can continue to drive margin expansion. They've already delivered some of that in recent years, but we believe that there's further margin expansion to be achieved. As we sit here in early April, I think the outlook still remains uncertain for markets. But I don't think that's an entirely bad thing for the trust. I think there's been a reminder to the market through March that actually it's often not a straight line recovery out of periods like we've seen. And actually there is still a lot of uncertainty around, whether it be consumer, whether it be macroeconomic, whether it be political. And actually in these headwinds, we think there's more of a focus comes back onto company specifics. We think this year could be less style nuance than we saw in 2022, for instance, where value really dominated markets. In that way, we continue to look at quality businesses. So we love businesses with strong balance sheets, strong cash generation, attractive margins. And also a lot of them are seeing very attractive investment opportunities at the moment, whether that be organic or through bolt-on acquisitions. We really like businesses who have that resilience, that visibility of revenue streams. That means when economic times do get tougher, we think we can continue to rely on these companies. We also continue to focus on that cash generation I mentioned, and that's really important in terms of the dividend payments that these businesses continue to make. We've been really pleased with the dividend strength shown last year, and we think that's going to continue if we look at the 2023 outlook. And lastly, I just highlight that we do continue to think that the UK market looks very attractive in terms of valuation. That's relative to history and relative to other geographies. And particularly the investment trust sector, we think a lot of the discounts are particularly attractive in terms of the opportunity that they can deliver to the end shareholder. The Matrix is our in-house developed stock screening tool, which we've used for over 25 years as part of our investment process. What the Matrix does is it really takes our whole investable universe and looks at stocks in terms of looking at the factors that drive our investment process. That's quality, growth, momentum, and valuation factors are included in that. We really use the Matrix, I would say, in two main ways. The firstly is for screening for new ideas. So we're always looking at that investable universe and the score that the Matrix awards to each company, which is ongoing, live, and gets updated twice a week. And anything which is scoring sustainably well in terms of the Matrix score or has an improving Matrix score is something that's interesting for us as managers and analysts to look at, to do the fundamental research on, and to engage with the management team. We also use the Matrix to look at the portfolio at any time. And we're in particular constantly challenging ourselves on any stock which has a sustained negative Matrix score, and why we still believe in that investment case and why we still believe it's quality, growth and momentum. And I think the last thing that's interesting about the Matrix is that the Matrix really removes any behavioural biases in terms of it has no emotional attachments to stocks. And I think that's really important when you are long-term shareholders and you know management teams well.